Hello, I'm David Frazier, aka the Market Monk. Well, stocks here in the United States in general continue to move higher today with the S&P 500 index making another all-time high, and the Dow Transports also making an all-time high. And those of you who are familiar with Dow theory realize and understand that historically speaking, whenever the Dow Transports have trended higher and broken out to new all-time highs, stock prices in general have tended to trend higher for at least several weeks, if not several months. In addition to the all-time highs recorded by the S&P 500 index and the Dow Transports, the NASDAQ Composite Index, the Russell 2000, the New York Stock Exchange Composite Index continued to move a bit higher. Stocks in India, as measured by India's Sensex Index, also broke out to a new all-time high, and Brazil's major stock market index continued to move higher over the next few days. In addition to the movement in those stock market indices, the advanced decline line for the New York Stock Exchange, that is the cumulative number of stocks advancing in price versus those moving lower in price that trade on the New York Stock Exchange, also continued to move higher today after breaking out to an all-time high a few days ago. So as far as the trading action in the financial markets, especially in the U.S. stock market, everything seems to be very, very positive at this time. And as you know, that doesn't surprise me, because as I mentioned in yesterday's show, I had told our subscribers this past weekend that I expected the U.S. stock market indices to break out to new all-time highs within the next couple of weeks. I had told them I didn't know it was going to be the next couple of days, and that I had advised them to get fully invested this past Monday. As I also expected, we had an encouraging report from ADP today, that is automatic data processing that does payrolls for thousands of businesses throughout the United States, showing that 191,000 private sector jobs were created during March as compared to 178,000 during February. And that 178,000 figure, by the way, was up from the initial estimate of 139,000. So we have some positive developments going on here, and I'm telling subscribers to our newsletters to stay fully invested, and probably going to be doing some active trading as far as recommendations that I make to persons who subscribe to our short-term trading recommendations. Now, I'm sure some of you watched 60 Minutes this past weekend and have listened to the financial broadcast TV shows over the past few days, and we've heard a lot of talk. The media's, at least the financial media's, focus on what is referred to as high-frequency trading. And boy, no surprise at all. What has the media done? What it usually does? It's sold a story rather than the facts. Meaning that, as I said in yesterday's video, extremely rarely can you go to the major financial media or any media in general and get the facts. It's entertainment. They write headlines to get attention. They say what sounds good and gets attention. And I had heard where this guy Michael Lewis, who was an ex-bond broker at Salomon Brothers back in the 80s, and is now a well-known author. Probably two of his more well-known books are Liar's Poker, dealing with the financial markets, and Moneyball, a book that was written about the Oakland Athletics that was later made into a movie. Michael Lewis supposedly said that, I don't recall exactly, but the entire stock market was rigged. Everything about the stock market is rigged. And he actually did not say that. I went to the source, as I always do. That is, I listened to his entire interview on CBS's 60 Minutes, and what he actually said was that certain elements of the way that stocks are brokered, the prices that people pay for stocks, is to some degree rigged. Now he went on to actually contradict that, not specifically, but what I mean is, if we really pay close attention to the specific definition of rigged means fraudulent, that is illegal manipulation. And later he went on and said, well, it wasn't illegal, and if it's not illegal, then it's not rigged. He chose the bad word. You'd think someone who's written a lot of books would have a better command of the English language, but I'm sure he chose that word because he knew it would get a lot of attention. And it's interesting, if you do some research on Mr. Lewis, you'll find that he's probably the last person that should be talking about something being rigged, given the way that he got his start on Wall Street. I'll let you guys look that up on your own, but that was not fraudulent either, but he definitely worked the system, and you guys can look it up on your own. I'm not going to get into that. I don't really care. What I do care about is a lot is being made about this by at least the general financial media, if not the media overall. And this is typical noise, is all it is. It's a distraction. And why do I say it's a distraction? Because I'm sure there is some truth. There's no doubt in my mind that there is some truth in what Mr. Lewis actually wrote about regarding these high-frequency traders, the ways in which they get trading information on stocks and before the masses do, even though it's only in milliseconds, and they take advantage of that information that they get before the masses. But it's all legal. There's nothing illegal about it. Is it unfair? Of course it's unfair, as Mr. Lewis said. Well, guess what? Life is unfair. I mean, give me a break. Everything's unfair. This is complete nonsense. It's a distraction. And how does it affect the individual investor? Almost to none extent. Almost to no extent whatsoever. You know, an individual might pay a few pennies more, if that, for a given stock when he or she buys a stock, as opposed to if this high-frequency trading did not exist. It's not an issue. And I find it interesting because what really is the issue is Wall Street, as far as the way that brokerage firms represent themselves to the individual investors, the way that most portfolio managers at mutual funds represent themselves, the way that these market strategists represent themselves. And that is, you know, these guys are who brokerage firms, you know, the salespeople are referred to as financial advisors, even though I would claim they're really just money collectors. They're, you know, they try to find a way to grow assets. I don't think they pay much attention to performance, and they're horrible financial advisors to a large extent. A lot of them, not all of them, of course. Of course, there are some good ones. But you know, what we should be focusing on is the advice that comes out of these Wall Street firms and these most mutual funds. And not that there aren't some great mutual funds out there too. My God, I'm painting a broad stroke here. What I'm getting at is something I mentioned yesterday, and that is, it's a lot of bad advice out there. That's something that someone should be doing a story on, how Wall Street is set up to make money for the people that work for Wall Street firms, investment banking firms, financial brokerage firms. They're not set up to help the individual make money. And that's quite the contrary is what we do here at Frazier Research and the MarketMonk. And so I encourage you to pay no attention to this story. That's all it is. It's a story. And to focus on what matters. And what matters is, it looks like to me that stocks are going to continue to move higher. So thanks for listening. I'll speak with you again tomorrow.